From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for September 16th, 2022. Checking the calendar. Start spreading the news. The New York Yankees are in town this weekend, followed immediately by the New York Mets. New York, the town's so nice they named it twice. The Bears are in Green Bay for a Sunday night game, and the Cedarburg Wine and Harvest Festival is this weekend. Electric trucks are a pretty hot ticket. In fact, so hot, a Texas doctor is using his Rivian EV truck to power his office while he performs vasectomies. And I've got nothing to add to that. We've all been witness to the ceremonies surrounding the life of Queen Elizabeth. As we know, they do things a little differently in Great Britain. For example, the royal beekeepers must verbally tell the bees the Queen is dead. And it gets even weirder than that. To honor the Queen, drug dealers are giving discounts on cocaine. Why would I make that up? A woman in Las Vegas airport skipped out on her lunch tab and was quickly arrested. She says the Las Vegas Metropolitan Police arrested her not for her dine and dash, but for being too good looking. I've seen her picture, and oh no, darling, they arrested you because you're a thief. Not that we don't have enough fests in Milwaukee, but Bucyrus, Ohio has a bratwurst festival. Hey, we're the city of festivals. Why don't we have that? I love brats. And an Australian woman's attempt to eat fresh backfired spectacularly after she was fined nearly $1,800 for failing to declare her $5 Subway sandwich in customs. Everybody's a food critic. Our headline of the week, Texan accidentally shoots himself in the face after bullet ricochets off an armadillo. He's going to be okay. And if you're worried, so is the armadillo. On the podcast today, we have Dave Sandstrom, Tom Pappenfus, Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A tough week overall. The NASDAQ down 5.5%, closing at the bell at 11,448. The S&P down 4.8% this week, closing at 3873. And the Dow Jones Industrial Average down 4.1% this week, down 953 points today. Although Friday may not have been the worst day for the Dow this week, closing at the bell at 30,822 for the year. The Dow now down 13.9%, the S&P down 17.8%, the NASDAQ down 26.4%. I hinted at the open here, Joel, that potentially Friday wasn't the worst day for markets. We saw that a little earlier in the week with what I think many called was a surprise report on consumer price index. I think as we're joking here, and not a great thing to joke about given how severe the market response has been, but as we were talking before the program started recording today, maybe not quite the surprise, maybe not quite the difference from expectation than what so many have written now this week.
Kyle, I don't think the report was a surprise as much as the reaction to it. It showed the broadest measure of inflation, the consumer price index, and it was up 8.3% from the year before. That's for the month of August, and that's a deceleration. It's been cooling off a little. It's still high. It's still near a 40-year high, but it's getting better. And actually, I looked at Dave and I looked at a forecast last week, and a Fed group was predicting that the forecast would that 8.3% was maybe going to be around 8.24%. As you said, that's a rounding error. So the fact that 8.3% came out, didn't really seem like a surprise.
Yeah, Dave, 8.5% the month before year over year, 9.1% the month before that year over year. Well, okay, all of a sudden the trend seems to be for inflation to be coming back down. And so if anything, I think I'm a little bit befuddled, I guess, about how the market could have such an outsized response to what otherwise is data that seems to suggest that inflation's headed in the right direction, even if we're not there quite yet.
Yeah, Kyle, I agree. It was a little surprising to me to see that type of a knee-jerk reaction. I think if you peel back the layers a little bit, I think some of the reaction can be attributed to the fact that the the core number, when you strip away the fuel and food prices, did tick up just a little bit month over month. And I think that was part of the problem, especially because we've seen gas prices come down significantly. That might have been leading investors to think we were going to see a healthier decline for the month. But to your point, certainly a vicious reaction to what did not seem like a real startling number.
And Dave, we actually had discussions about this in the brokers meeting on Monday, that sometimes those year-to-year comparisons are deceptive because you're comparing against whatever the base was a year ago. You have a base effect. And for that core CPI number, it happened to be actually kind of a little low last year. So the reason it went up wasn't so much that inflation was going at a higher rate. It was more that core number was a little low comparatively the year before.
Yeah, that's a great point, Joel, because I think what we're going to hopefully see is in the fourth quarter now, you look over the year-over-year numbers, fourth quarter last year in 21, we saw significant increases across the board in inflation. So just mathematically speaking, that should give us a little bit of a tailwind in this fourth quarter to see those numbers start to come down.
And you can see it a bit in energy prices, right? You look at the price of a barrel of oil and the year-to-date increase up 13.5% as of the close of business today. And yet, as we start to get into the very end of this year and into next year, because those comparisons are so much higher, yes, the price of a barrel of oil will be higher than it was 18 months, 2 years ago amid a terrible COVID shutdown. But also keep in mind, it's now on a year-over-year basis going to be stable or lower if it is where it is right now. And so I think, as we look at inflation, it's so important to remember what we're measuring it against, right? How are we measuring this? What are we measuring it against? Over what time period? And I think so critical to understand that there's this natural headwind that starts to kick in come fall. Forget what the Fed is doing. Forget what the overall economic picture looks like. It becomes more difficult for inflation to persist at that rate. And yet, Tom, the markets continue to be in the midst of this bear market. You look at the S&P, again, year-to-date down, almost 18%, and that's a pretty meaningful decline. And I think a lot of investors are so used to, these quick recoveries, these quick kind of return to normal, to these prior high water marks. It's what we saw post-COVID. The market sold off steeply and recovered just as quickly. But I think something for investors to remember that that's not always the case.
Yeah, I think we find in our position these kinds of years generally tend to be stress test kind of years, just to kind of it's a good time to recheck your balance, how much risk you have. I've done a lot of kind of going through a process of resetting expectations, if you will, based on we've had this period of time, let's say from 2010 to 2021, of just outstanding market growth. And I think the S&P average maybe somewhere around 14% a year, when historically it averages maybe 9% a year. And to be fair, I'm kind of a reversion to the mean person. If we had 10 years of just outsized growth, I'm kind of the wet blanket in the room, just saying, hey, we're going to get back to normal, and that might mean we might see a little bit lesser returns going forward. And also, to your point with, in the middle of a bear market, since 2008, I think to my recollection, there's been 3, maybe 4, roughly 20% or more corrections in the marketplace. But the time length, recovery time to get back to where we were going into those downturns has been quite short. And I think, again, kind of what I'm walking people through right now is that this may take more or follow more of a traditional bear market playbook. It may take another year or 2 years to recover. Maybe it's not in 2023. Maybe it's 2024. And so we do need to do some resetting of expectations, have a plan in place. And truth be told, that's really not outside of the normal. That's really more typical of a bear market. And so we shouldn't be too shocked by it. But I think there is some level of expectation that needs to be reset for this time.
And I think the saving grace for that part of the conversation is that, we've been planning and are always planning for the realities that bear markets are just part of the investor experience, right? That we're going to go through periods in time in which we may not see a new market peak for a couple of years. And that happens sometimes. Some of that is maybe we got a little bit too far ahead of ourselves a little too quickly. Some of it, though, is that's just a natural part of being a stock investor, and that's what the other half of the portfolio is for, right? That's why you have bonds. It's why you have cash. It's why you plan ahead. And, of course, I think important to understand that bonds now can do more of the heavy lifting, at least until stocks find their footing again.
Yeah, I think for all of our different demographics of clients we may be working with, whether it's young, accumulators or perhaps people more retired and income dependent. I mean, there's a silver lining to both of these. If you're younger and you're an accumulator, if you're adding consistently to your employer-sponsored plans or any type of investment account, you're capturing lower prices, right? But if you're perhaps a retiree or more income dependent, to your point, Kyle, yields have gone up. I mean, I think the outlook and the forecast for bond performance looks quite promising. I mean, we've seen a dramatic increase in yields. Not only that, but the nature of what is doing well or holding up better in this environment tends to be value focused funds or dividend payers, lower PE, lower beta stocks that a lot of those people have probably been holding on for a while and maybe have been lagging in a high growth world, but now they're looking pretty good.
Yeah, no, I think that's a great point, Dave. The 30-year mortgage rate hit 6% for the first time since prior to the financial crisis. I think, so many folks out there who were looking to refinance already did that. And so what's left now is those home buyers, those people looking for a new mortgage, trying to figure out, okay, how can we afford that house where prices are largely in most areas at or near record highs? How can we afford that house now that mortgage rates have doubled in the span of a year? I think as we talk about what the Fed's intended consequence is, well, that's part of it, right? Is you slow the economy by making it more expensive to borrow. Mortgage rates at 6%, part of that.
And Kyle, I think it's important to point that out because, as difficult as it is for us in this period right now where we see the markets going, the Fed is doing their job, right? They need to address inflation. We can't have this type of atmosphere persist. 7, 8, 9% inflation is no good over long stretches of time. So the Fed's doing their job, and the areas that they can impact, and you bring up probably the one that's most obvious, and that is mortgage rates. It's working. I mean, we've seen mortgage applications have dipped down to their lowest level since 1999. That's a significant impact. Now, is that something that is enjoyable, that we, like? Well, no, but it's part of this process that we need to slow things down. We need inflation to come down. So it's a bitter pill to swallow, but it is necessary. And that's why in so many of these instances, the Fed has brought about a recession. But in this case, they're doing what they can, obviously, to engineer that soft landing. And with as tight as the labor market is, they actually might be able to pull that off.
Yeah, this may be the one scenario where the economy is strong enough to withstand this incredible storm that the Fed has created, right? That, okay, well, you're slowing mortgage applications to, where it was 20 plus years ago. You're making it that much more expensive. So first-time home buyers maybe don't have the resources to buy the house and fill it with all the new furniture and appliances that they used to fill it with. Maybe it takes a little more time to do that. And so that's I think, as you rightfully point out, it's the intended consequence of what the Fed is doing. We got word today from FedEx that maybe put the markets in a bit of a tailspin again today, that some of what the Fed is doing is cause their outlook to change pretty drastically. And so you look at FedEx and UPS and some of the big shippers, I think, being a key component of kind of our expectations for the global economy. When they see things slowing down, you take notice. Well, all of a sudden the markets today responding to their word that, hey, we're pulling our guidance, we're telling everybody, hey, things could be a little worse than what we thought. Well, okay, I think it's clear the global economy is slowing. It's clear the Fed's part of that. The European Central Bank is part of that. China's zero COVID policy has been a big part of a lot of what has led to that, and potentially, China's slowdown overall a part of that. And so, I'm not surprised by it, but also it doesn't overly concern me. when you look at the earnings growth that we were forecast to have this year, and as we look through the end of the year, the S&P's earnings growth is largely flat with the exception of energy companies, and energy companies have positive earnings growth because of oil prices. And so I think as we look at where we are, well, the things that, Tom, you mentioned earlier, some of those value stocks, high dividend payers, high-quality names, well, some of that's been the oil businesses that have held up this year. They're the piece that's held up earnings. As we look ahead to 2023, though, all of a sudden the forecasts call for the rest of the market to start to come back, not implying the 15 or 20% earnings growth that I think a lot of people would hope for in the kind of recovery that, is going to be a little bit slower, Tom, as you point out. But I think, on the order of high single digits points to a market recovery that will be meaningful but more plodding than what most people are hoping for. Joel, a bevy of economic data this week. Certainly the CPI numbers were the ones that caught the vast majority of headlines, but some other stuff that I think stood out pretty meaningfully to me, the retail sales maybe top of mind, a sign that consumers are still spending.
Yeah, Kyle. So we had numbers today from the University of Michigan, a preliminary look at consumer sentiment for the month of September, and found that consumers have great uncertainty over what? Inflation. It's what everybody's talking about. And that really has an impact, or can have an impact, on spending. And we know that spending generates 70% of the gross domestic product in the United States. So this concern about inflation on the one hand by everybody is disconcerting. But at the same time, we had retail numbers showing that spending is continuing. So, on the one hand, consumers are worried. On the other hand, they're still spending money, and that's good for the economy. Of course, that spending isn't as robust as it used to be, and that's good for the economy, too, to try to keep the inflation in check. But this month we had, for the month of August, we had retail sales go up 0.3% from July, and they're up 9% from a year ago. But part of that has been inflation, because that takes into consideration that prices are going up, so people are spending more. But if you adjust it for inflation, actually that's kind of good news is if you're in the bandwagon of seeing consumers spend, because that showed that retail sales actually went up in August, controlled for inflation, for the first time in 4 months. So it's not just the higher prices anymore that's generating those retail sales. A part of it is just people are out there spending.
And of course, data on producer prices as well, another inflationary measure. When input costs go up, you'd expect that the price of the goods you're buying would go up as well. And I think more news there that if nothing else, the inflation picture is moderating.
Yeah, that actually was more encouraging than the consumer price index. It's, measuring it on the wholesale level rather than on the consumer level. But it showed that the year-to-year inflation rate for the wholesale level was the lowest it's been in 12 months. Again, it's, up there, it's elevated, it's the highest we've seen in decades, but it's going down. It's been going down for, I think, 4 months in a row, and that's actually a good-looking number. And another number that was important this week was employment number, the initial claims for unemployment insurance. And, you were talking before about how the Fed is looking at inflation. Well, they also look at employment. And, you were remarking how it's a relatively strong economy into which the Fed is raising interest rates. And they're looking at inflation on the one hand, and they're trying to balance that with employment on the other. And every report that we get that shows employment is relatively strong, which most of the reports on employment are that. We had the lowest jobless insurance claims that we've had since June, and they're like 39% below the 55-year average. So it's really a healthy hiring market. But that emboldens the Fed. The Fed sees that and says, this economy is doing pretty well. Maybe we won't plunge it into recession, or it won't be that bad of a recession when we raise these interest rates.
Yeah, I liken it to the Fed trying to land a plane in the middle of a snowstorm, and the shorter the runway, the more precise you have to be about where you put it down and how quickly you stop it. And I think right now the Fed's dealing with a pretty long runway for what, the possible outcomes are. And, to me, that sets us up for, the pain might persist, that pain that Powell talked about out in Jackson Hole. It might persist for a little while longer, but there's less risk right now of that plane running off the end of the runway than there probably was in a lot of other environments where we're dealing with high inflation and the Fed needing to raise rates. So at least some encouraging signs there. I think, unfortunately, the inflation picture continues to be the thing in focus next week with the Fed meeting again. The virtual certainty of a 75 basis point rate hike been baked into the cake. A snowball's chance that you get a 100 basis point move. I think there's some folks talking about that, but it seems unlikely given that the Fed's been pretty clear about what the path forward looks like. In the end, it's probably irrelevant whether you get 75 or 100 next week to the long-term picture, because there's probably at least a couple of more moves ahead as long as inflation remains the conversation. What's so interesting to me is that in addition to the Fed next week, we're going to have a pretty important announcement mid-October for so many of our clients, an update on what the cost of living adjustment looks like for Social Security. A reminder, of course, that, and Joel, you and I were talking about this, you can slice and dice of inflation 10 plus different ways. How you put it all together and where you measure and when you measure and how you measure are all part of it. That cost of living adjustment based on just one more measure of inflation that, is just a little bit different look than, maybe just the traditional CPI or personal consumption expenditure. So, again, I think the estimates right now looking at, potentially 8.5% to 9% cost of living adjustment for inflation. We'll know more in a month, and certainly that'll be something we're talking about here because it impacts so much of what we do. The more you can get from Social Security, the better off your retirement looks. But of course, at the expense of some other areas potentially. So we will be keeping a close eye on that. We'll be keeping a close eye on what the Fed's talking about next week. As always, we enjoy doing the show. We'll have plenty to talk about next Friday. So looking forward to doing another one, and we'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.